Hello. Stock markets are at record high levels globally. The global nature of this market rally is important. This rally is primarily driven by the huge liquidity that has been injected into the global financial system by the leading central banks of the world. So primarily this is a liquidity driven rally. If we look at the mother market, the US market, Dow Jones, Nasdaq, S&P 500 all touched record highs recently. European markets are doing exceedingly well. Most emerging markets are doing very well. In India, as I speak, the Sensex is around 43,000 and Nifty is about 12,800. This is indeed a very pleasant surprise. Investors have been taken aback by the ferocity of the bull run and this very pleasant surprise. When the Nifty crashed to less than 7,600 during end March, nobody would have thought that the index would bounce back sharply by around 65% from the low levels of March. But this is how the market behaves. Markets have an uncanny ability to surprise everyone. The relevant question now is, where do we go from here? Will the markets continue to rise, or will it consolidate at the current levels, or can there be a sharp correction triggered by some factors? Now, we know it is impossible to predict market behavior. Therefore, instead of making a prediction which can go wrong, I would like to visualize 2 or 3 different scenarios and how these different scenarios will have their impact on the economy and the markets. Scenario number 1. This scenario assumes, this is a very, very positive scenario, a sort of a Goldilocks scenario for the market. Here we assume that the success in COVID containment will continue. We already have success stories on COVID vaccines from Pfizer and Moderna. More are in the offing. So if a vaccine becomes available in early 2021, it would be possible to contain the virus. There will be a progressive unlocking of the economies. Economies will bounce back. We also assume that inflation continues at subdued levels for an extended period of time. This will facilitate an accommodative monetary policy, continuation of the accommodative monetary policy of the leading central banks of the world. Under such circumstances, even though the markets are at high levels, markets will continue to rise. It is possible that emerging markets like India may get a further wall of liquidity, and this liquidity can surprise the markets again and push the markets higher. Already till 18th of November, the FII inflows at more than 33,000 crores is an all-time high for a single month, and liquidity can surprise on the upside. Therefore, this is scenario number 1. This is a very possible scenario. There are many experts who believe that this is even the beginning of a structural long-term bull run in the markets, but we do not know. This is a possibility. Scenario 2. In this scenario 2, even though vaccine becomes available, it may be months before it becomes available on a sufficiently large scale to immunize a substantial segment of the global population. It may take several months. In the meanwhile, if the second wave and third wave of the COVID attack, which is happening now in many parts of Europe, many parts of the US and Europe, well, instead of unlocking, we can have further lockdowns of the economy, which is very much possible. So instead of an economic recovery early in 2021, we may experience a decline in economic activity in 2021, at least in the early months. So that is another scenario. The vaccine taking too long to become available, the logistical constraints in scaling up the production of vaccines and things like that. If this happens, it is quite possible that the upward rise of the markets may be arrested. The markets may not sharply decline. The markets may consolidate in a range at around the present levels. So that is scenario 2. Now let me come to scenario 3. This is a negative scenario from the market perspective. In this scenario, well, the risk to the market, and this is the biggest risk in the market at present, the biggest risk in the market is the return of inflation. We know that huge liquidity has been injected into the global financial system. Almost $20 trillion have been injected into the global financial system by the leading central banks. This has never happened in history. This is unprecedented. Normally, this kind of liquidity should have triggered inflation, but it has not. Even post-2008 Great Recession, loose monetary policy, cheap money policy did not trigger inflation. But we do not know that inflation is completely killed. If inflation gets triggered by this huge liquidity, then it is quite possible that the central banks might withdraw from the accommodative monetary policy that they are following now. I'm not saying that they are going to tighten monetary policy within few months, no, that is unlikely. But if they withdraw from the accommodative monetary policy, it is quite possible that interest rates will start going up and stock prices will correct. There will be a sell-off in the markets. There will be capital outflow from emerging markets, and you can see a big sell-off in the market. This is the biggest risk in the market. This is certainly not going to happen in the next few months, but this is a probability which cannot be ruled out. So these are the 3 different scenarios. So how should investors respond? Investors should respond by looking at these important variables: the vaccine, the effectiveness and the availability of the vaccine, the containment of the disease, interest rates and inflation rates. These are the important factors that should be monitored, and investment strategy should be changed according to the new emerging situation. So presently, investors should remain invested. We know from experience that remaining invested in quality large cap stocks is an investment strategy which can reward investors handsomely in the long run. So remain invested in quality large caps, particularly in performing sectors like private sector banks, IT, pharma, now autos, and sectors which are performing very well. Now, valuations are very high. There is more value in mid caps and small caps now compared to the large caps. But then ideally, investment in mid caps and the small caps should be done through the mutual fund route. Those who are doing SIPs, this is very important, continue with the SIPs. Stopping SIPs had always been a loss-making proposition. So continue with the SIPs and observe the different variables which I have mentioned, and see how the 3 different possible scenarios, which among these different scenarios play out. Stay invested, stay safe. Thank you.